So a second consideration for a cargo claim that could be present for a freight broker is when they sign a contract. And in that contract there's an indemnity clause, and essentially it says if the motor carrier transporting that shipment doesn't pay for the cargo claim, the freight broker is now contractually bound themselves to pay that shipper. They need to have the right policy in place for that. If a contingent cargo legal policy is not the right policy, because that covers freight broker authority. Now you've contractually expanded your liability beyond freight broker authority, which has limited liability. Now you've contractually said, you know what, I'm going to move your freight, but I'm also going to step up and be your cargo underwriters and pay for any claims that are not paid by the trucker. That requires an entirely different policy. There are two types of principal formats that can respond to that exposure. Potentially a broad form contingent cargo policy. That can have application. It depends on the cargo that's being moved. If it is not the right type of cargo that fits into broad form contingent cargo, then a second option that would address it is a shipper's interest program. And this is a great vehicle offered many times by freight brokers that move LTL freight and international freight forwarders. And what it allows the freight broker to do is on a shipment by shipment basis offer full coverage for that particular shipment. And the costs are not necessarily extensive when you break it down on a per shipment basis. So a smart freight broker will offer that option to clients, and they'll give them two freight rates. One freight rate where it's agreed upon that a cargo claim should be responded to by the trucker. A second option is where they agree to indemnify them, and as such they offer a shipper's interest program, and cargo coverage is put in place on a shipment by shipment basis. That's done through a website that we set them up with where they can automatically bind that coverage.